Welcome to a new season and episode 49 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya.
And my name is Tamanna Surya.
And today we are thrilled to have Gary Heffernan as our guest on this podcast to discuss the Warner Brothers Discovery bidding war between Netflix and Paramount Skydance. By way of disclosure, I have a position in Netflix and Lionsgate Studios. And before we begin, we want to state that nothing in this podcast is meant as investment advice. Please refer to our disclaimer at the end of this podcast for more detail.
Gary, thank you so much for coming on. We really appreciate you being here. We would love to have you take a few moments to introduce yourself.
Great. Thanks so much for having me. I guess, quick disclosure, I do not have a position in Warner Brothers Discovery, but I'm more than happy to talk about it. My name is Gary Heffernan. I am an individual investor. I started my training at an investment bank in New York out of school. So I worked at Barclays Capital for several years in the natural resources group. After that, I worked as an equity research associate at Capital Group companies. They do the American funds and covered a variety of industries. Mostly a generalist over there, you could say. And after that, I spent a little time in Silicon Valley and did a brief detour at Google doing some finance work for them. And now I'm just an individual investor, investing on my own, connecting with like-minded individuals like Asif and others who like following special situations.
Great to hear, great to hear. I think to set the stage for our conversation today, it's worth mentioning some of the background for the merger that we want to dive into, especially for listeners who may not be very familiar with the deal. So Warner Bros. Discovery was created in 2022 when AT&T spun off its Warner Media assets and combined it into Discovery in what's called a reverse Morris Trust transaction. The transaction takes an asset of a company and merges it with another public company instead of spinning it off as an independent asset.
Yeah, I had previously been invested in Discovery, but by the time of that merger with Warner Media, I had exited my position. It was really weird. I'd seen an interview by John Malone about Discovery and Netflix, and strangely enough, I did end up with both those stocks in my portfolio. And I don't know, Gary, if you remember the whole Bill Huang Archegos situation with Discovery. The stock started running up a lot. It nearly doubled on me, and I couldn't quite understand what was going on, and I ended up exiting the position. And then a few months later, we found out what was actually happening behind the scenes with that whole Archegos situation. So the reason I did not get interested in Warner Brothers Discovery post-spinoff was because it seemed like it was a highly leveraged company with a lot of debt on the balance sheet. And that was one of the concerns I had, having suffered the scars of the post-dot-com bubble and the post-Great Recession. I didn't want to get into a leveraged company. And sure enough, Warner Brothers Discovery went on to lose more than 2/3 of its value by September 2024. Almost a year later, in September 2025, the Wall Street Journal reported that Paramount Skydance was preparing a bid for Warner Brothers Discovery, and the stock was trading at just a little over $16 per share after that news came out. So Gary, can you take us a little bit through the pre-deal situation and what your read was of Comcast, Paramount, and Netflix all bidding for this asset?
Yeah, I'll start with some history and when I get involved. I'm less of a merger arb and more of a deep value investor. And so my interest in Warner Brothers Discovery started in probably around 2024 when the shares were very depressed. Several years after the Bill Huang episode you had mentioned with Archegos. And what I saw in the company was a gem, a jewel of an asset in their film and television studios and intellectual property libraries, overshadowed by a very unloved cable television business, which was generating the most significant part of the company's earnings and cash flow. The stock market tends to focus on earnings and cash flow, tends to overlook asset value if the assets aren't being configured and utilized to their fullest extent. But it was pretty clear to me that these studios, if the price is too low for too long, will start attracting interest from strategics or even very rich individuals who just want to get a hold of a trophy property of which there aren't many, and confer significant, clout. If you own a movie studio, you kind of are a big shot. At least that's what these people think. And so I invested on the thesis that the worst of the troubles of Warner Brothers were behind them. They were not going to go bankrupt. They were generating significant cash flow. This was demonstrated by their ability to pay down, tens of billions of dollars in debt after the Reverse Morris Trust. And it almost reflected like an option that at some point someone would come along or the company would break itself up to highlight the value of its more attractive businesses, and all while they were scaling a streaming service, which looked like it was going okay, and could be successful and maybe contending in the streaming wars. So that was the background of my interest. The company embarked to separate itself and split off the cable television assets from the streaming studios business. And this happened earlier in 2025, right around the time that David Ellison closed his deal for Paramount. So it became Paramount Skydance. And shortly after he acquired the Paramount studio, David Ellison launched an unsolicited bid to acquire Warner Brothers. And this was, the stock was trading at about $12 probably at that time when the news reports started coming out. And David Ellison bid against himself in rapid successive fashion to get the stock price up until media reports started suggesting that his bid was around the mid-20s before the company officially kicked off a sales process. Due to all this unsolicited interest in the rise in the stock price, my read is that the Warner Brothers board had to consider putting the company up for sale. If they had walked away from the unsolicited bids, the stock probably would have collapsed. And at that moment that they put the company up for sale, the board's duties became shifted towards getting the highest value for shareholders in a sales process. And it doesn't necessarily mean the highest price per se, because there are other factors that weigh in, but it really is the board's duties become secure the highest value for the company in an auction process, as opposed to thinking about the long-term interests of shareholders, which is what they typically do. And so the auction process kicked off, and obviously Paramount was one of the bidders, and then the other two bidders that showed up to the auction process were Comcast and Netflix. My understanding is Netflix entered the process in late October, right around the time of their earnings call. And so if you look at their share price since that earnings call, you can see that it has basically collapsed, which is maybe a suggestion that Netflix shareholders aren't too excited about the prospect of this this acquisition. Okay, so Netflix and Comcast entered the bidding war. I'll start with Comcast and their prospects for winning first. Comcast was unwilling or unable to offer a lot of cash to acquire Warner Brothers. And note that Paramount is bid is all cash, so it has to be compared against Paramount's bid. And to me, that just said Comcast never really had a chance of winning the bidding war contest. Comcast also is one of these companies that has a collection of disparate assets under one roof, like a conglomerate structure. And so what they offered to do was to separate their media assets, including theme parks, and value it at a pretty high valuation and contribute basically close to 50-50, go 50-50 with Warner Brothers and create a new company. That did not succeed. It's not surprising it did not succeed. It did not immediately deliver the highest value for shareholders. It delivered maybe a very uncertain value for shareholders, given that you would receive stock in a new company. And, as Asif was talking about earlier, he watched the Warner Brothers Discovery Reverse Morris Trust. That's a pretty similar situation where you're taking two company assets, put them together, ascribe a value to that business in a new publicly traded stock, and then sort of see what happens. And it didn't go well for the Warner Brothers Discovery Reverse Morris Trust. It probably opened around $24 and traded down to somewhere in the sevens at one point. So Um, very easy to see why that bid would not succeed. So it really was between Netflix um, and Paramount.
Yeah, Gary, you make a good point about Netflix shareholders not being thrilled. I'm a Netflix shareholder. I wasn't thrilled as a shareholder. As a consumer of Netflix content, I was thrilled. I was like,
Yeah,
I'm going to get to
yeah,
see more content on Netflix. And in some sense, over time, I've warmed up to it. I see the value. I see why both of them are fighting for that asset. But initially, my initial reaction was, what is Netflix doing here?
yeah. No, I'm actually interested to hear even more about your opinion because I'm not a Netflix shareholder. So you definitely have a viewpoint that I'd like to hear about.
I mean, when you think about Netflix and Reed Hastings stepping down as a founder, you always have that concern, right? Are the next CEOs going to make the right decisions for the company, or are they going to become a roll up, end up leveraging the balance sheet, so on and so forth? So, this was a little bit an indication that that might happen.
Hmm.
So, it was the initial knee jerk reaction of what is Netflix doing? They've been doing fine so far without making these massive acquisitions.
Absolutely.
And you
Yeah.
think of Apple, Apple is a similar story. And this divergence from that was probably a shock. But then, you put on your second thinking hat, as Daniel Kahneman tells you to, and you start to realize that, there's more value here to be had for Netflix over the long run because the library is just so valuable. I would love for them to go out and buy Lionsgate as well, which is a
Yeah.
company that we've been sitting on for several
Yeah.
years. But consolidation is something we can talk about during the regulatory risks part of this deal.
Yeah, we should definitely talk about the regulatory risks because I completely agree that if Netflix were to succeed in closing this deal, I mean, they look unstoppable. So that should be good for the stock,
Yeah.
unless it's so good that it's bad from a regulatory perspective.
It's a
Absolutely.
super important factor to consider. So basically, after this pre-deal bidding war, as we implied, Netflix came out on top. In early December 2025, they announced this massive $82.7 billion deal for Warner Bros. And then again, some added context for listeners who might not be as familiar with the deal, as a cash component of $23.25 per share, and then about $4.50 worth of Netflix stock, though that stock consideration is subject to a collar mechanism. I do think another interesting part of the deal structure to me personally has to do with the way they plan on spinning off the Discovery assets, which includes things like CNN, TNT, and other cable network channels, into a separate company first. And that's kind of different from the way this Paramount Skydance bid is positioned, and we can dive into that a little bit. And so if the other interesting part is that if Warner Bros. Decides to reduce the amount of debt it offloads into the spinoff, then the reduction in debt leads to an equal dollar for dollar reduction in the cash consideration Netflix will pay for Warner Brothers as well. Gary, what do you make of this Discovery spinoff? And are there any comparisons, parallels, or considerations you can draw from the recent Comcast spinoff, spinning off their cable networks division, Versant as well, which includes channels like CNNBC, USA Network, and more?
Okay, Tomina, you just hit at the heart of the matter. So this is great. If I forget to address some of your points, just ask me again because there's a
Yeah, of
lot in
course.
there.
Yes.
So, disclaimer, Warner Brothers Discovery cable assets include CNN, and that's like a pretty political hot potato. And so if, you are you lean one way or the other, you might not be too happy, or you might be happy to see CNN go to any particular bidder's hands. And so I just don't want to talk about that. But a lot of political commentary does talk about it, but we're just going to ignore that for today's discussion. So Paramount wants to acquire the entirety of Warner Brothers Discovery, including their cable networks, which would allow Paramount to take the cash flow from those cable networks, combine them with a similarly positioned business at Paramount, achieve synergies by reducing, SG&A to the tune of, $2 or $3 billion, and basically achieve scale in the cable television business. Netflix obviously does not want to acquire that business. In the agreed upon merger, Warner Brothers will spin out their Discovery cable networks at some point this year. Probably the third quarter is what they're targeting. So if you back up, the contention between or the tension between Warner Brothers and Paramount right now is that Paramount is saying $30 all cash is a superior bid versus what Netflix is offering. And Tamina laid out what Netflix is offering, and it includes what was valued at $4.50 of sorry, of that's of the Netflix stock. So $4.50 of Netflix stock, if it was above a certain price, plus equity in a new company yet to be formed called Discovery Global Networks, and that's valued at about, we think valued at about $3 per share, but the board actually hasn't told us how they're valuing it. And so if you look at each of those components, I'll touch on Netflix briefly. The Netflix consideration is actually below $4.50 right now. I had it up on my computer earlier. I lost it. It's probably closer to $4.10 right now. I know that doesn't sound like a lot of a change, but it's only been a little over a month since this deal was signed. And I mean, this variable consideration could go lower, it could go back up higher. Unclear, but it's just important to keep in mind that it's not $4.50 anymore. It's probably closer to $4.10. And then the value of the equity in the to be formed or to be spun out company Discovery Global Networks. Most people who are following this situation think the best comparable company to Discovery Global Networks is Versant, which was just spun out of Comcast. So it's the cable TV assets that spun out of Comcast. And it has been trading very poorly since it started trading earlier this year. It was not unexpected that it would trade poorly because it's kind of an orphaned security. Asif, I don't know if you've covered this in some of your work, and if you want to
Yeah.
Yeah.
We covered a similar situation when Lionsgate spun out Stars. So we look at it in a very similar fashion, and that's why I didn't spend much time on it because, as you know, these things trade like, as you just mentioned, an orphan security. There's very little interest in it. On our spin-off tool, we have a completed spin-off tool. We track the performance of both the parent and the spin-off to see how they're doing. And as you mentioned, Versant is not doing well for reasons many of us expected it not to do well.
Yeah, exactly. And so Versant's trading, its debut has been poor. Most sell-side analysts were valuing it at a range of between 4 and 5 times EBITDA. And I think right now it's actually below 4. But even if you used 4 times EBITDA and you use the median of analyst consensus for the relevant time period at which this company will become public, so basically the 4 quarters after 3Q26, it really doesn't imply a lot of equity value for Discovery Global Networks if it's capitalized with $15 billion of debt, which is what we expect it to be capitalized based off of the debt allocations that were outlined in the Netflix deal. And so this creates sort of this this downside risk to the cash component of the Netflix offer. And so if Discovery Global Networks has to reduce the debt on its balance sheet when they spin it out, that amount of debt will be subtracted from the cash consideration Netflix is paying for streaming and studios, or at least that's how I read the deal. That's how Paramount reads the deal. The Warner Brothers board doesn't really talk too much about this, and they don't seem to want to. And so, to sum it up, you have a cash component that may actually not be worth the stated amount, depending on how Discovery Global Networks trades. You have a stock component that's already below the level at which they thought it would go when they signed up this deal. We were talking earlier about how the Netflix stock has gone down quite a lot since they got involved in this process. And then you have equity in a yet to be spun out company that is of unknown value, but in a very unloved sector, is unlikely to attract a shareholder base that's interested in buying this stock. And so it's just kind of messy and uncertain. At least, I guess I want to just back up a little bit. It's messy and uncertain from the perspective of considering it for a merger consideration, right? Like you have to
Yep.
take a view of what these are worth at a point in time relative to what Paramount is offering. And so, in the future, just as an example, Discovery Global Networks could be acquired by private equity or merged with someone and be worth more than 4 times EBITDA.
Right.
But my view is that may not necessarily be the most important factor when you're comparing it to an all cash bid. And that same sort of analysis goes for the Netflix stock consideration. Like the Netflix stock could rebound significantly in the future, but it's just you can't really rest. You can't hang your hat on that when you're comparing it to just straight cash.
Yeah. Taman and I were talking about this earlier is the reason Michael Lewis's books are so interesting, whether you think about The Big Short, Moneyball, or even Liar's Poker, is because he focuses on the people as, the central part of a story. And the one person I think of that's, central to the story is David Ellison. So tell us a little bit about David Ellison and especially his tenacity with staying the course and Skydance eventually acquiring Paramount. I think that'll set the stage for, why the Ellisons are so important in the story.
Yeah, what a bad time that was. So I am
Yep.
still a Paramount Skydance holder, just for full disclosure. I completely agree. The people almost matter the most, I would say, because they're going to be faced with a lot of decisions on how to move forward. And if you're working with, or if you're investing behind someone who is, a winner, for lack of a better word, like your success of your investment increases based off of their ability to win on your behalf. And you don't really have to do anything except like appear on podcasts and talk about the stock. So yes, David Ellison and his partners at Redbird, Jerry Cardinale or Cardinale, I don't know how you pronounce it, acquired National Amusements, which was the holding company of Paramount Global, from Sherry Redstone. And this was a very high profile acquisition. It went, into the media. It spilled into the media in a very similar way to this deal, where you were reading about it every day in the newspaper, and the stock would be, gyrating based off the latest news reports. So what happened with Paramount is it's a significantly smaller company than Warner Brothers Discovery, and did not find its footing as well, I would say, in the streaming era. It spent a lot of money to scale a streaming service, and had a lot of debt in doing so, and was never really seen as likely to succeed on its own. While this was happening, there was a holding company that controlled Paramount, that at the time was controlled by the Redstone family, by Sherry Redstone, daughter of Sumner Redstone, who was the driving force behind Paramount Global, which was previously Viacom and CBS. And the Redstone family, through National Amusements, had found themselves in financial stress, because at their holding company they also owned a movie theater chain, Showcase Cinemas. And Showcase Cinemas and movies just got obliterated during COVID. No one was going to the movies. And there was that movie theater business was capitalized with too much debt, and basically threatened to really put the Redstone family in a tough spot if they couldn't refinance the debt. And it was looking like they were not going to be able to refinance the debt. And so that's my read anyways of the situation. And so Sherry Redstone was basically forced to sell at least some of her stake in Paramount or National Amusements, to gain some liquidity. And this was all happening at a time when, one of the biggest assets held by National Amusements was Paramount stock, and Paramount stock was massively depressed. So it's just a very tough position to be in. And so Sherry Redstone launched the sales process for National Amusements, and it attracted a lot of suitors, a lot of interest. At one point, Apollo and Sony teamed up and attempted to buy Paramount Global. At one point, it seemed like Sherry Redstone was going to walk away and not even sell the company. But through this very long process, David Ellison and his partners at Redbird, came out on top and signed a deal with the Redstone family. And so the other thing that happened during this was the need to transfer television station licenses that were held by CBS, now subject to FCC approval, which is not a factor in the Warner Brothers deal. And that also had a lot of complications and dragged on because of the political nature of television station licenses. And I mean, at least as told by the news, because it's not like I have firsthand knowledge of what was actually going on, this was settled by paying $16 million to one of the Trump libraries or foundation. I don't actually know. It's one of Trump's interest projects, and may have been the deciding factor in getting the license transfer approved by the FCC. Maybe it had no factor. I don't really know. But the point is that David Ellison stuck through this very long process of winning Paramount from the Redstone family when Sherry may have never really wanted to sell it, her family business, and then battled the FCC to get station approval and succeed in closing the deal.
That's a good point, Gary, especially about the television stations, because you right now have a deal where Nexstar is acquiring Tegna.
Mm-hmm.
And everybody thought that deal was just going to go through quite easily until Trump came out and said he's not keen on seeing so much consolidation. So everybody thought the FCC chairman was aligned with making that go through. But now you hear something different, and the spread on that deal has suddenly widened.
It just adds another variable to a lot of deals, which is, is the administration going to position itself in a way to extract a concession for themselves? And sometimes they do.
Indeed.
Absolutely. And you mentioned that, I guess, that television station consideration being one of the differences between what's happening between the current Warner Bros. Discovery deal and what happened with Paramount and Skydance in the past. Are there any parallels you're noticing between the two bids from the Ellison family these days?
I would say when Skydance was acquiring Paramount, it really was just a change of, as far as I'm concerned, it was mostly a change of ownership. They did merge in the Skydance studio. There is probably a lot of technology there that I'm not too familiar with that may be very helpful to restructuring Paramount. But from the perspective of like media scale, Skydance is a small production company, and changing control of Paramount to Skydance doesn't necessarily solve what's Paramount going to do in this very challenging world against Netflix and Amazon and Apple and Warner Brothers and others. And so what I see, at least as maybe it's almost like a continuation of a master plan that may have been hatched that we didn't know about, which was the Ellison family first had to acquire, one studio before attaching on another one that would then give him significant scale and be a scaled media company in studios and streaming. And so that's kind of how I think about it. And it might be wrong. I don't know these people. I don't talk to them. I just read all of this stuff in the news like everybody else and try to think about what their motivations are and what incentives they have to do what they're doing.
That's fascinating, Gary. I don't think we thought of it at all. That he did the Paramount deal first in order to then go acquire something else. But it's possible. I mean, they are, at least Oracle is extremely good at consolidating in the industry. It buys software companies. It feels like literally every other week you end up seeing them buying a massive software company or the other.
Yeah.
I think so. Moving back to the main Warner Bros. Deal, then I think the question on every investor's mind is, what is the superior bid? And there's a lot of factors to consider for each bid's merits and issues. So maybe we can dive into that through the rest of the podcast. I think something we hinted at earlier is that the main risk in any M&A process, honestly, but especially this one, is regulatory risk. And it seems as if every political figure, ranging from Elizabeth Warren to Donald Trump, have all weighed in on the situation. I was just wondering if you had any insights into the regulatory risks for both the Netflix and Paramount bids, and that too, where do they sit from a competitive position across the entire media industry, especially when you consider other studio businesses like Amazon's MGM or Comcast's Universal Pictures?
No, I think this is what the entire deal hinges on. I think this is the question.
Yeah.
And I don't want to upset anyone. I can't answer it. Like, I don't know how regulators are going to view this, but maybe I can share a link that you can put in the show notes, or you can get your viewers access to it another way. There was a congressional hearing last week that talk about these very issues. And so, I think the most important point on any deal that's potentially going to be challenged by the antitrust authorities, which it looks like this one is, or at least it'll be looked at heavily, is what is the relevant market and how is it defined? And so, with Netflix, if the market is defined by antitrust authorities as, subscription video on demand, they have such, and maybe it's by subscribers, like they have such a dominant platform that some estimates suggest they already have 30% of that market. And if that's the case and they're going to add to it, they face a higher standard. Like at least in the congressional hearing that I was watching, it was suggested that, they're already kind of presumptively illegal at that size. And so it doesn't mean that they can't acquire it. It just means that if the antitrust authorities challenge this, it's on the burden might be flipped back to Netflix to prove why it's not an illegal deal. And so I look at the Netflix deal is potentially having a very hard road ahead. I don't want to say no chance, but it looks very difficult in my perspective for them to close this deal. Now, what Netflix, I think, wants to do, which is what most companies want to do when they're acquiring something, is expand the market definition as broadly as possible. And so I think Netflix wants to say, well, hey, we compete with YouTube now, and maybe we compete with, I don't know, TikTok, and look at, no one has a big market share in that world if you define the market that way. And if that's how regulators view this, if they say, okay, if Netflix raised their prices too much, people flip to free YouTube, and we have data to show that, like that would be a pretty compelling argument that a free service is something you can substitute to. But I mean, just look at, I wish I had a chart. Look at all the streaming companies, how they've been able to raise prices over a very long period of time. That suggests to me that they know consumers are not going to switch to a free alternative. Otherwise, they wouldn't be able to raise their prices that much. So I don't know how this is going to shake out. I see a lot of risk with Netflix. I want to get back to that, but let me just cover Paramount quickly. With Paramount, their streaming service only has around 80 million global subscribers. Warner Brothers is around 120 million. I don't know the exact overlap, but a combined streaming service between the two of them puts them in the realm of a Disney Plus, and they would be behind Netflix. It looks to me like it would create another competitor in streaming and would not be of a market share size that would be problematic. So the streaming side looks okay. The studio side, I'm less positive on. If you look back at a similar deal with Disney acquiring the Fox studios, my understanding is that the reason the studio combination was not found to be anti-competitive is because they did broaden the market definition beyond just traditional Hollywood film studios. And so it just comes down to like, how are the regulators going to view that? And then, Linear television, I mean, gosh, it does look like it would be incredibly consolidated in linear television if Paramount were to win. And I think that might be, why they're trying to sort of sort of push the message that that business is dying and needs consolidation. And so unclear on that front from my perspective.
Yeah, and they have options. They can work with the regulators and say we will still spin off Discovery if that appeases the regulators and helps the deal go through. But you're right, Gary. I think it's the lens through which you look at this that makes a big difference. And if you look at it from the lens of Larry Ellison being close to Trump, then it goes through. But
Absolutely.
so,
Absolutely.
so that's a
Yep.
huge factor here.
Mhm.
But also, it kind of depends on whether they're going to look at it from the lens of two movie studios combining or is it streaming services, and that's completely unclear. I think this will be a great case study for law students who are going
Absolutely.
into M&A law to look at in the future.
I was just going to say, and we're talking about federal antitrust when we talk about the influence of the Ellison family and its relationship with Trump, but states also have antitrust laws, and I don't know much about them compared to say the federal ones. But if you watch the congressional testimony, there's a lot of suggestion that states are potentially going to fight this as well through their attorneys general. And it just seems to me that it wouldn't be such a slam dunk, even with the Ellison connection, if you have to battle states as well from the Paramount side. So just that's another thing to think of too.
That's interesting. Yeah. I mean, certain kinds of deals, like insurance deals, do require like state insurance regulators to come step in. If it's a banking deal, then, there's a different regulator that looks at it. So you make a good point. International regulators, state
Right. Those
regulators,
two.
all of these could lengthen the timeline of the deal. So people who are in the ear for a merger arbitrage situation might see that this drags out much longer than they would like to see it drag out for, and hence that impacts their internal rate of return or IRR. And so it's not just about whether this deal is going to close. How long will it take for this deal to close? That's important as well.
Yep. And that's between that and my view that Paramount doesn't seem likely to raise their bid at this juncture. That's why I moved on from the Warner Brothers stock earlier this year. It just, to your point about this could take a very long time. It could drag out. It could be challenged. There's a lot of stuff to do in the markets from a portfolio management decision, and there are other, to me anyways, I think there are other more interesting things.
So let's briefly touch upon one more issue here, which is that the combined company, Paramount and Warner Brothers together, would have too much leverage. And
Hmm.
could that end up putting them at risk for bankruptcy because bonds are likely to be rated junk if this happens? So could you talk a little bit about that?
Yeah, I think that's a good point. And so the headline leverage ratio I think is around 7 times pre synergies, which is a lot. And
Wow.
so if this was an LBO, which is how the Warner Brothers board is characterizing this, meaning a financial buyer loading a bunch of debt onto a company and then running that company a certain way to pay the debt down, that would be a problem that would be a very big, in my opinion, bankruptcy risk. But these are two companies with similar business lines combining. And I don't think that headline leverage ratio will be the most relevant one. Question is, what is the relevant one? Paramount says, they'll be at 4 times leverage with synergies. The counter argument to that is I don't really know what those synergies are yet. And, if we go back to that Paramount process, when Paramount was being sold to the Ellison family and Redbird, they continually raised the amount of promised synergies throughout the deal, like to sell the deal. And so you do wonder if they're trying to sell this or not. So I think it's, if I had to bracket it, I would say it's going to be between 4, which I'd be fine with, and 7, which I would not be fine with, times leverage. I find it very interesting that the Warner Brothers board recently decided to say the leverage ratio itself would constitute an LBO and be a problem, because that's not what they were arguing at any other point during this process, arguing as a way to reject the deal. And I just find it very bizarre, because it is of no concern to them if they can close the deal what the company will do thereafter, because they are cashing out all their shareholders. I did look at the merger guidelines, and this could be totally off and totally wrong, but I looked at the merger guidelines from the Department of Justice Antitrust Division, and they actually suggested that an LBO with too much leverage could be, considered anti-competitive, because it might kill the company on the other end and remove them from the picture. And so I'm wondering, like, is Warner Brothers trying to push that angle to get the antitrust enforcers to look at this deal and say no good? I don't know. It's just a speculation.
And I wonder if that's something the Paramount executives will then bring up, saying that even if it is an LBO, obviously they shouldn't be guiding to a bankruptcy, but maybe the validity of that LBO argument might not be as prominent.
Yep, agreed.
I think the one last consideration is that there's been some opposition from the media industry to both sides of this deal process, whether it be Paramount, whether it be Netflix, about jobs being cut, and other major actor unions, for example, opposing the deal and kind of looking at the considerations. I was wondering if you had any insights into those and how that might maybe even play into the regulatory aspect of it, how it might not, and where both parties are sitting when it comes to opposition from media players.
Yeah, I think that's the right question to be asking. And I'd remind you, I'm an individual investor reading alone in New England. So I don't know for sure. But, if you looked at that congressional testimony, and you'd have representatives from, say, states that had a lot of Hollywood presence, they obviously care about what's going to happen to their constituents and will voice concern accordingly. And so no one wants to see a massive amount of jobs lost from this process. I would say in any situation where you have an industry structure that doesn't, I don't think the current industry structure is really working for Paramount and Warner Brothers. They face significant competition. One way for them to sort of continue to exist in the industry ecosystem is to achieve scale. And so I guess the point I'm trying to make is you usually have to consider the counterfactual to what happens if either scale is not achieved or if the industry structure is not changed. And that's something I do want to talk about after this point. One insight, I guess, I would say about your question is that when you read the media reports on this deal, it's important to keep in mind that they're comparing what David Ellison will do to the entire company in terms of synergies, which is sometimes a euphemism for job cuts, but not always, because there's going to be technology synergies as well. But they're comparing the entire company of Warner Brothers from Paramount's perspective to the streaming and studio side for the Netflix deal. And they're not saying, well, what's going to happen to Discovery Global when it's spun out and on its own? And it's, Best Comparables trading at 4 times EBITDA, which is a suggestion that its financial outlook is not very good. And so, what happens to Discovery Global by itself, Discovery Global Networks by itself? And is it better for that business to be in someone else's hands or not, is sort of where I'm going with this. From the perspective of Hollywood players that I've read about, James Cameron does not favor the Netflix deal. And he's a pretty significant voice in filmmaking. I'm sure there are plenty of people who do favor the Netflix deal. I haven't spent too much time on that angle. Maybe myopically, I've just been focused on the fact that the board of directors Revlon duties to achieve the highest price for shareholders is active, and that's just kind of the main thing they have to focus on. And so that's the main thing I've been focusing on.
Absolutely, Gary. You said it right. The board of directors needs to act in the best interest of shareholders. And that's what one of the most successful merger arbitrage funds that I like to follow, Pentwater Capital, the
Oh
CEO
yeah.
was in CNBC. And he was saying the same thing, that he wants the board to engage with Paramount rather than just trying to, get away from that bid, if you will. So Pentwater has been in this deal actually before there was a definitive merger agreement. They got involved when there was this potential bidding war between Comcast and Paramount and Netflix. And we saw something similar with them with US Steel. They got involved in US Steel before the Nippon Steel deal was inked. And then they became very vocal after they had a large position towards the beginning of this year, or maybe beginning of 2025. I forget that we are in 2026 right now.
Yeah.
And then late 2024 as well. So I wonder if they are in year, they're expecting a higher price, not the price that is their year, but at the same time, they made a lot of money on this deal already if they were involved at the time they got involved, but they're staying in, they haven't exited yet. So I wonder, I know you are out, you feel like, Paramount's ability to go higher is less. But I wonder if they are looking at it as if the board engages with Paramount, then maybe Netflix is forced to do a higher offer if they're keen on closing this deal. So just want to get your thoughts on that.
I think that's absolutely right. I mean, you mentioned that Pentwater interview on CNBC. I recommend your listeners watch that. I have a lot of respect for Matt Halbauer and Pentwater. They seem to be on the right side of a lot of their decisions. They seem to be very good at what they do. And, from their perspective, they are, at least I assume a part of their fund is a merger arbitrage fund. And so they might see a compelling merger arbitrage opportunity in this. Whereas I'm not a professional merger arbitrager and just sort of would rather go buy a deep value stock instead. And so that's mostly the reason why I've started looking elsewhere for my portfolio. But the risk of me passing now on Warner Brothers is that, like you said, a bidding war does break out. And so what do I want to say about this? David Ellison, in rapid succession, bid against himself to start this bidding contest in the September timeframe. And the speed at which he was able to move and increase his bid in the first several bids out of the 7 or 8 he's done is like pretty shocking to me. And now that there's a signed merger agreement with Netflix, he has not moved off his price for over a month, almost a month and a half, and is not giving any indication through press leaks that he's willing to move off his price. And as far as I can tell, my assessment is $30 cash is better than what Netflix is proposing. So David Ellison might just be saying, I'm not going to keep bidding against myself when I already think I have the better proposal. And so that just gives me pause in expecting a further bidding war to break out. And so you add that to the fact that, when you and I were looking at media stocks before, no one cared about these things. Now everybody is talking. Like, I get texts from all sorts of friends talking about Warner Brothers that they had no interest before, and they're all sure there's going to be a bidding war. And it's like, I don't know. That just gives me some pause when everyone starts to think, like, everyone thinks something. Maybe that's just not what's going to play out. And that gives me a lot of pause.
Yeah. Gary, I wonder if you and I just have a high tolerance for pain to get involved with these media companies where it takes years for some of the stuff to play out. It certainly seems to be the case in my case, because I'm not a media specific investor. I'm a generalist.
Yeah.
Yeah. It's surprising that we find ourselves with these media companies.
Yeah.
Speaking of the bidding war, you make a good point that a lot of people are expecting a bidding war. Pentwater probably expects the price to go higher. The whole thing does remind me of Oracle's bidding war for PeopleSoft. It was a hostile bid. Larry Ellison was keen on acquiring that company. And if I remember correctly, and I probably mentioned it in my book, The Event Driven Edge in Investing, that the final price was actually twice the original price. That's how far it went with that deal. But it was also Larry Ellison's Oracle was in some sense competing directly with PeopleSoft. And so that acquisition was important for them. And eventually, PeopleSoft's co-founders went ahead and created another company that competed with Oracle, which is Workday. And we have a position in Workday as well. So just taking that into context, I know this is not Larry Ellison, it's David Ellison. But, Larry was willing to go twice his original price to get here. To your point, David Ellison was competing with himself in some sense, and the price kept going up. So, in that perspective, just as a quick comment, I wanted to add that maybe this does go a little bit higher before it gets settled.
I think that's completely fair. I don't, I hope anyone who's playing for bidding war, gets it. I'm just not so sure.
I think just to wrap things up, we've guided a lot of this conversation about the deal thus far, and we were just wondering if there's anything we haven't dived into that you were looking to highlight or speak about.
Yeah, sure. So this is something I've been thinking about for the last couple of days, and I'm not sure how heavily I'd weight its occurrence. I don't know that it's going to happen, but it's something that I'm thinking about. And if I were to see signs that it's happening, I might start recalibrating my expectations for where the bidding war is heading. And I'm going to do a lot more research on this, tonight. And so earlier, we were talking about, how players are viewing this acquisition and, the potential for job losses and that not being a favorable thing for the industry, and just how challenged both Warner Brothers and Paramount have been in their how challenged they've been relative to some of the bigger players in the industry. And so to me, that just says this industry structure is not ideal. And as, stock guys, we usually think, oh, you solve that by getting scale, do a merger. And that's sort of what's been playing out so far. But another way this could actually work is that the industry structure is changed by the government. And again, this is me speculating, and I don't have all the details, so I'll probably get some of it wrong, but there's a parallel to this. And so in the 70s, before the rise of cable TV and definitely before streaming, everyone got their entertainment and news on the big networks, big three networks. And the big three networks owned the content that they were distributing through their channels. And that became a problem because it was perceived that they had too much power. And I think it was Nixon used his FCC to implement what was called the financial syndication rules to basically just break up the ownership so that the networks couldn't own all the production studios that were creating the content. So it was a way of separating distribution from content production. If you think of that as potentially being a parallel to where we might go in the future, it's already being proposed by John Voight, who's the sort of the special ambassador to Trump. He's like the special Hollywood ambassador to Trump, and he's proposed this as of mid last year. And so I asked myself, well, how did this get implemented last time around? And it was through the FCC, and the FCC has special authority to regulate television networks. Well, it's not going to happen through the FCC this time, I don't think, because they don't have the relevant authority unless it's granted to them, which I just don't expect. And so the other avenue through which this could be implemented is through the antitrust authorities. And so I find myself wondering, well, how could the antitrust authorities justify putting Netflix's business model under a huge microscope? They would have to first start with an antitrust investigation into their acquisition of Warner Brothers. And so I just find myself wondering if that's where this is headed. And suddenly, Netflix gets out of the business of creating content and just becomes the premier distribution. Like, they're still the leading streaming service. They'll be the leading streaming company. But the production companies all of a sudden don't have to be in streaming anymore. In streaming anymore. And that's the expensive part of their business they don't want to necessarily be in. And then Netflix has to buy the content from the studios at, cost plus some percentage. And suddenly the studios become these libraries of intellectual property and licensors of content that are far more asset light and not so burdened by running these streaming networks. And maybe the studios that have small streaming networks, spin them all off and combine them. Like, I don't know. There's a lot that could happen, and it would be catalyzed by an antitrust investigation, which looks like might be coming our way. And so that might be one reason why Ellison is not increasing his bid. Just something to think about.
That's a fascinating thought process there, Gary. And you're right. I mean, the new streaming services are the television networks of the 70s, right? Because they have the distribution locked up at this point. And clearly, Netflix has both the content and the distribution side, in some sense, through the streaming. That's just completely fascinating. We'll have to think a lot about that as well as we continue to follow the story and as it evolves over the next few weeks or months or years. I don't know how long this goes on.
Yeah.
The longest merger arb situation we came across was something that lasted almost 4 years. So I don't think this goes anywhere close to that length, but I think it'll take some time.
Which one was that? Before we go, which one was that?
This was Genworth Financial. There was a Chinese company that was trying to acquire them, and that had to go, to your point, state by state to get every state regulator to approve it. And in the end, you ended up with a pandemic, and the acquirer didn't have the money to complete it. And so it fell apart 4 years later.
Jeez.
Merger Up guys did well because post-failure, the company ended up actually doing quite well. So that was an interesting, unique situation.
Yeah.
And that's, I think, a great note to end our podcast today. So just one last thank you from both of us, Gary. Really, really appreciate all your insights shared today.
Yeah, thank you so much for having me on. I'm really glad you got me out of my shell to do this, because at first I didn't want to because I'm so shy. So I really appreciate it. Thank you both. And it was very nice to meet you, Tamina.
It was wonderful to meet you as well.
Thank you, Gary.
And that wraps up episode 49 of the Special Situations Report. It was absolutely wonderful having Gary Heffernan on our podcast as our guest for this week, and we'll go back to regular programming next week covering all event-driven activity. However, if you'd like to access a more comprehensive weekly overview of all special situations activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the event-driven world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on. Thank you.